For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thanks for the invite. Appreciate it.
So it seems like things are constantly changing when it comes to financial markets. How do you keep track of changes in things like interest rates, for example?
It's a real challenge, and it's a good question because, again, more and more we're hearing, is the Fed going to cut? Are they not going to cut? And if they do cut, how much are they going to cut? And then again, hoping, I think most people out there, as far as that are borrowing money at least, are hoping that interest rates, as they cut, interest rates on mortgages will come down proportionally. And as I shared last week, that's not necessarily always the case. The chart I brought along today is a little different slant. It's looking at what we refer to as the yield curve, and it's probably one of the best tools that we find as far as to try to look at interest rates and where they're going to go, what have you. And what we historically see is that the short end of the market, in other words, like a 2-year bond or CDs, maybe even a better example, when interest rates are fairly high there, historically you see the long end even higher, and vice versa. What we see as far as on the blue line is that's not necessarily the case. If you look at the blue line as it moves to the right, we see that things have gone up. So we're in a period of inversion, is what it's called. Fancy term for that. The long end is higher than the short end. So hopefully we're beyond that, and the red line is kind of illustrating more current times, and things seem to be falling more in line with historical parallel between the two.
Okay, so how should investors think about this change?
Well, the market, the bond market isn't just one bond. So you need to understand as far as what part of the bond market you want to be in. Unfortunately, most individuals, they just kind of generically think in terms of investing in bonds, and that's not a good way to do it.